All right, we've got about 30 seconds until we are going to get things going on our Sunday, I guess, morning, technically, edition of the weekly stock market scan. All right, that is the timer. We are going to get things started. For those of you who are tuned in, thank you for joining us on a unusual time, 11 a.m. Eastern time, but we're going to knock this thing out bright and early this morning, and hopefully we'll have a nice plan in about an hour or so from now. So what we're always going to do first on these is we're going to take a look back at what happened last week. Last week, unfortunately, we lost some money, which it happens. If you look at that year-to-date summary tab we had up, fortunately, it doesn't happen very much, so I'm confident we're going to be able to get that money back pretty quickly. And if we take a look at the weekly tracker, we could pretty much identify that there were really only two main places that these losses came from, right? It was the big drop in UWMC and then the big drop in Palantir as well, which accounted for a $3,500 loss. So outside of that, we made roughly $2,300. Obviously, if these didn't happen, it would have been an incredible week, but you're not going to win every single trade every single time. Let's talk a little bit about how we plan on getting some of this money back. And I think first and foremost, we're going to talk about Palantir because that's one that we rolled into the upcoming week. So we've got our trade breakout tab that we haven't updated yet, right? So let me quickly pull up on another screen the trade alert I sent out. So for Palantir, here's what we did to manage our position, right? We sold the strangle, the 24 strike call, the 22 strike put. The call expired worthless for a $190 profit. However, we had to close this put out for a 70-cent debit because the stock dropped so much. So that increased our loss overall. But what we did was we rolled this again, and let me quickly just pull that down. We didn't roll it down and out. We rolled it out, but not down because, when the stock dropped so much, we couldn't afford to do so for a credit. We wanted to roll something for a credit. So what we were able to do was sell the same exact strike, 22 strike, with an 11.26 expiry, and we did so for, I think, let's see, it looks like 96 cents. So we got a 26-cent credit on the trade. And what that means basically is, if we had these the 10-22 strike Palantir puts that we sold that expired last Friday, if those expired for max profit, we would have made $240, which is, great, but that didn't happen. And since we were able to roll these for a 26-cent credit, the good part now is we still have that same profit target of being above 22 a share. But now if these expire worthless, not only are we going to get that 240 that we initially had, we're going to get an additional 260. So I think if I did the math right here, this should come out to $500 of profit. So, downside is we have to wait an extra week. But, the saving grace that we kind of have is the fact that we were able to roll this for a credit. And with that credit, we now can make 500 off of the puts as opposed to the 240 that we initially could as well. So what does that mean for our break-even price? With that initial strangle, our break-even price was $23.32. Now that we're going into a further strangle, I guess I should add the note here that this is strangle part 2. And with that part 2 of the strangle, there's also going to be some calls that we try to sell, right? But we haven't done so yet. And the reason being is because, honestly, the premium didn't look incredible, right? If we go over to Palantir, we take a look at the weekly option chain, looking at November 26th, up near that 24 range that we previously sold, right? There's only 4 cents of premium. Even at 23, there's only like 10 cents of premium. So the premium just isn't incredible for what we're looking at. I mean, maybe we could be conservative with the 22.5 because at least if that gets called away, we know that we're going to hit our max profit on the 22 strike puts that we sold. But for now, I just don't think the premium in this range, which is where I want to sell them, is high enough. So I'm hoping on Monday, Palantir opens green, and then we're going to be able to open these for a little bit more than what they're currently going for and drive that break-even price down. But before even selling this, and I'll highlight this to indicate that we haven't done it yet, these 22 strike puts, we're going to put in the equation in so we can calculate what they're worth. 22 minus this. There we go. So at Palantir's current price, closing price on Friday, which was $21.41, these would be worth 59 cents, meaning we'd make 370 back. So again, still not quite back to where it needs to be, but let's kind of play with this number right here to see what our overall break-even price is. Obviously, the position right now is in a little bit of a loss, but that's okay because, we got in on this thing November 9th, which is 12 days ago at 24.8. And since then, it's dropped over $3, which is a 13.67% drop in just 1.5 weeks. And for a stock that's normally as consistent as Palantir, that's a really out of character large drop. So I'm expecting some sort of bounce in the near term, but let's see how big that bounce would need to be to get us back to break even. So we could throw 22 in there. We know at 22 that would get us to max profit on the 22 strike put. However, we still have some pretty big residual losses from our other positions, so we're going to need some greater stock gain. So if we go up to 23, we're still, down a little bit here with 60, but 23.06 is going to be our new break-even price as of right now. So as of 11/19, which was last Friday when we rolled these, our new break-even price is 23.06. And as you can see over the course of this trade, which is again just been a week and a half, our total reduction in our break-even price is 7.02%. So we've done a decent job managing that. And, a quicker way to calculate this was you'll remember that we got a 26-cent credit between closing these for 0.7 and reopening them for 0.96. So that 26 credit is a direct reduction of our cost basis right here. So I guess we could say strangle, parentheses, the puts. And right now we're at 23.06, and that's not taking into account these 24 strike calls or whatever we do choose to sell for 11/26 expiry. So we'll just put calls with a question mark. And again, if we wanted to be a little bit more conservative and just go down to 23, we'd be able to sell the 23 for 10 cents a piece. And if we threw that in there, our break-even price would be 22.96, and that would get us fully below 23 in just a week and a half after starting the trade at 24.8. So we've got a decent amount of flexibility. I like the stock. I like where we're at. So I'm going to hang tight, hope we get a little bit of a bounce, because if we look at the chart here, if it loads for me, this is the 3-year obviously, but even on the 3-year chart, you can still see some decent levels of support around where it's trading, right? This red line that we have right here is at 21.23, and it's demonstrated support in that range, and I think secondary support would be around the $20 level. But I'm hopeful that we get some sort of rebound here. If we look at the 180-day chart, it's definitely oversold as far as RSI is concerned, and we love RSI as an indicator for short-term, movement in a stock, right? This thing it peaked at 29.29 just back in September, and it even got back to 28 just a couple weeks ago at the beginning of November. So definitely a lot of room for this thing to rebound. And why do we like RSI? It's because when you historically take a look at when it gets down to these levels, you see some pretty big rebounds. It gets down in the blue right here. You see a nice rebound. It gets down into the blue over here, and you see a couple short-term rebound. And again, that's not saying it's going to run back up to 30 or anything like that, but we're taking this trade on a week-to-week basis. And as far as a short-term rebound, this RSI level is definitely indicative of, at least over the next 4 or 5 days, being in a position where it could hopefully rebound above 22 for us, which would put us in a really good position moving forward on the position that we're running. That was a kind of our big loser of the week, and it's one of those things where even though it was a loser last week, and it took a decent chunk out of our profits, right? It took, let's see, $1,700 out of our profits. All these losses in theory are temporary, and if this thing gets back up to 22, 23 next week, we could potentially be looking at a gain before the end of the month. So I'm gonna put the Google Finance formula back in here. This is where it stands. We might sell calls Monday morning depending on where the stock goes, but that is where we're at, and we're perfectly happy with that, right? Because all these gains that we had from last week, if we control click these and see how many gains we had, we had $3,000 worth of gains. We're out of these positions. Those are locked in, right? These can't be touched. That's money in our pocket that cannot be taken from us. These losses, as we've demonstrated with how we plan to manage our Palantir position, these losses are temporary. So we should be able, to get them back at some point. So, we could go a little bit down the list here. SPIR was one we've been holding on to for a while. XELA had a decent gain, and I'm glad we got out of this, right? I think one thing that we did well last week, even though we did have a couple missteps with Palantir and UWMC, one thing we did do well was closing positions early, right? We were able to close a CLOV 6.5 strike put that we sold for 14 cents for 3 cents. And you might say, at the time it may have seemed like, hey, 3 cents, I could just probably easily collect $45 more here, right? But if you take a look at the CLOV chart, one important thing to keep in the back of your mind is the fact that a lot can change in just 2 or 3 days. And when we were able to close these out, I think this is the day that we sold them on Tuesday, and it ran back up above 7. We got out of the trade. Just 2 days later, this thing was down at about 550 off some bad news. So always important, if on a Monday or Tuesday you have a significant percentage of your gain that you could take off the table and lock that profit in, definitely advantageous to do so. And that's what we did right there. And then we were able, since we were out of the trade, when it dropped even further right here on Wednesday down to that 550 level, we were able to get right back in and sell some 5.5 strike puts as well, which netted us a quick $90. So instead of holding out for an additional 45 here, we were actually able, with our patience and, discipline and closing that position out early, we're able to swoop in when it dropped even further. And instead of picking up that extra 45, we got an extra 90 to make $255 off of this one last week. But Draftkings was one we took profits on overnight. JMIA was one there was some earnings volatility that we were able to take advantage of. DM was unfortunate, right? Because this one was at 12 cents, and this gets back to the point of being a little bit too greedy coming into the week, right? Because this would really have only been $120 for us, and at the worst, I think this thing got up to like $1 of premium, so we were looking at an $880 loss. That was definitely a mistake on our part. If we take a look at that DM chart, it wrapped up at 691. So when it spiked back up to 730 on Wednesday morning, this is when we got out of that. It was at 882 headed into Monday, which is unfortunate. But that's just kind of how it works sometimes, and something we can consistently try to do better at, as well as getting out of these trades early so you don't get kind of screwed as they go down to the wire. And then maybe last thing to talk about is, as far as last week is concerned, is BRPM. And I know we've got a request in the YouTube chat to talk on that one a little bit. But I think the plan is working so far, as expected, right? We came into the week with these at 1029, went up to 1067. That's a 380 gain on those just over the week. I think our basis in the shares when we started trading it, 1061 was 1084, right? So we're still at a little bit of a loss on the position overall. But again, the way that this trade works out, there's very limited downside to about the $10 level until their merger in Q1 of 2022. So we have another month or two that we can sit back and wait on that. But we've started to see a little bit of the volatility that we were expecting on this thing, right? If we go back to the 20-day, it did start to level out a bit. These things can get a little bit boring, but you can rest assured that, this $10 level on a pre-merger SPAC is going to hold relatively strong. So we have very little downside. And if we get anything like this candle that we saw back on October 26th, we're going to have a very good amount of upside in the near future. So BRPM is definitely one that we're going to be hanging back onto and holding onto and waiting for. We've got 6-7 weeks before the end of 2021. So hanging tight on that, hoping for another candle. We got a little bit of action, a little bit of volume right here with this candle on a Wednesday when they announced some good news with the Draftkings partnership. But I think as this thing approaches the merger, with how much hype is surrounding the potential acquisition target, the FaZe clan, I think this could be a very good one to keep holding on to. So that's our position right there. If it gets back down to this 10-15 level, we might add some more to our position, but perfectly happy to just wait week by week, even though it can be boring sometimes, and just let this thing do what it needs to do. And one question we get a lot is, what's our plan if something like this does happen? We see another big green candle up. And I think DWAC is a good example to look at how to potentially front end of a big run up like that. So if we go to the 180-day chart, we go to the big run up, you see these candles are pretty consistently green and big. If we had the 5-minute chart, you'd see some dips throughout the day, but none of the dips were really larger than 75 cents or $1. So I think our plan with BRPM is, if we do start to see some upwards movement like this, is to set a trailing stop loss order at about 75 cents to $1 below the current price of the stock. That ensures that as the stock keeps increasing, your stop loss target keeps increasing as well. So you can still capture all those gains while protecting your downside by having that stop loss there below in case it does drop over $1 at some point during the day. But that's going to be our plan to get out of that one if we do start to see some action with it running up. And that should pretty much recap most of what we had. ASTR, that was another good one where we got in, we got out for $200 a profit. We sold a 10 strike put, and while if it stayed above 960, it would have been a good idea for us. However, this thing dropped down to, $9 at one point, $9.50. So we came out on top by taking our profits on this little candle right here and moving on to the next one. So we haven't actually built out what we're holding for next week. And I think this is going to be a good discussion because, a lot of these trades that we had were 11/19 expiry because last Friday was monthly option expiry. Excuse me. However, we've been holding on to a lot of 11/19 trades over the past couple of weeks. So from a buying power perspective, our hands were kind of tied about what we could and couldn't open. We were really things like SPIR where we had $18,000 tied up. Things like Visalink, DM, Palantir, RDW. I mean, pretty much everything right here is an 11/19 expiry, right? So as far as what we could and couldn't enter last week, our hands were tied, but we were okay with that, right? Because we were still able to collect a really good amount of premiums on those options. And again, everything outside of Palantir and UWMC performed really, really well for us. So we were happy to let that play out how it did. But for this upcoming week, right, a lot of these positions are gone. Really, the only positions we're rolling into the next week are the UWMC, Rocket Lab, BRPM, that Palantir position. And I think we rolled CRISPR as well, along with adding some UWMC 6.5 strike puts because they've added weekly options on those. But let's roll this thing forward real time since I didn't do it before we got on the stream here. So give me 1 second. We're going to highlight these rows, and this should be a good live example of how easy it is to roll the old profit tracker forward. So it's now the week of 11/21. Throw that in there. We know that all of these trades right here are going to be gone. We're going to delete those rows. We know we're rolling with Palantir, but these are all gone. We know we still have CRSP, so we're going to delete all of these rows as well. And that leaves us with this little stack that we've got here. And what you're going to want to do is just copy these, paste the values right here. And there you go. Everything's been zeroed out. Commissions need to be zeroed out. Take the ending balance of the S&P 500, copy and paste it right in here. So that's now zeroed out as well. But this is kind of the stack of what we have going for the upcoming week. And we did, in addition to rolling that Palantir forward, we also rolled our CRISPR position, right, for a little bit of a credit as well. We closed the first back for $1.97, as we saw up there, and we opened a new set for $2.25 of premium. And those are now 11.26. We rolled them down. And like with Palantir, when we said we always want to roll things down and out for a credit, and we weren't able to do that because Palantir dropped too much. With this one, we were able to roll them down to 83 strike and out for a credit, meaning now we collect even more money with a lower profit target from a stock price perspective. So that was a really good move for us right there. We were happy with how that one turned out. And then the other thing that we did add for last week was, I believe, we sold some more UWMC. And I'll put this in up here. We sold, 20 UWMC 11.26, 6.5 strike puts, and I accidentally just clicked out of that sell. 6.5 strike puts, and we sold those for a 39-cent credit. So what that means, obviously, is if, hold on, we tag this one as a new position. These are new positions. Okay, so there you see it right there because I haven't put the other value in and debit to close. But at a high level, if UWMC finishes above 6.5, we're going to have $780 in profit on that one. So even though we don't have a ton of positions right here off the bat, the ones that we are currently sitting on look to be potentially pretty profitable for us, right? And one thing with Palantir, again, we rolled these forward to 11.26. And these are still 22 strike puts, but we now sold these for 0.96, I believe. 0.96 was the number. Let's double check that over here. Yeah, 0.96 was the number. So there you go. Let me put these at 0.96 so we're not showing too much profit here. And then we have the 26 and to be determined calls that we are going to sell. So we'll highlight these because these are TBD. Got to remind myself to open those. And on Friday, I think Palantir, if I have it on the watch list here, went up 12-ish cents after market close. So hopefully we're going to be able to get a little bit more premium on those when the market opens. And again, these blue highlights mean that they expire a week of. They're now weekly options, and we love holding weekly options because we benefit so much from theta decay of the extrinsic value on options. And when you're running those down on weekly options, that decay of the extrinsic portion, that theta decay, is exponential in nature, meaning we make more and more money. So we always like to stick with the nearest expiry possible. But at a high level, again, one thing I like to do at the beginning of a week, kind of evaluate where we stand and how much money we stand to collect, is kind of play with these, right? If UWMC finishes above 6.5, we're taking home $780. If Palantir gets back up to 22, that'll go up to 22. These will expire worthless. We may or may not, add some calls right here. We'll see about that. And then if these CRISPR 83 strike puts expire worthless, I mean, just right there off of 4 positions that we've kind of messed with the price, that's $3,000 of profit. So we're really set up for a nice week, I think, for the upcoming 4 or 5 days. And I say upcoming 4 or 5 days because another important point about this week, if we look up stock market holidays, is that Thanksgiving is on Thursday, which is almost insane to say because I feel like this month has come out of nowhere. And if you go to the New York Stock Exchange website, you'll see in 2021, Thanksgiving Day, it looks like the market is going to be open. However, the 2 asterisks mean that the market is going to close at 1 p.m. that day. So not closed for an entire day. The next entire stock market holiday that we have is going to be on Christmas, Friday, December 24th, which obviously is Christmas Eve. But, do not have the entire day off. However, that's, 3 free hours from 1 to 4 p.m. of theta decay. But that's definitely something to keep in mind because I know when you're managing positions, Thursday afternoon is a good time to decide if you want to take things into Friday or not. Just need to remember that Thursday afternoon, the market is going to close at 1, so you'll need to make that decision a little bit earlier. But that's something to keep in mind for the upcoming week in the market. But this is what we've got. And again, we say this, I feel, every single week on Sundays when we talk during the stream. It's a pretty short list of trades, and eventually things happen Monday, Tuesday, Wednesday. We react to those things. We add new trades, and typically the new trades that we add, like even with what we had right here, and that's including some of that Palantir loss, but just the new trades that we added last week netted us $775. The week before that netted us $492, and that still includes some of that Palantir loss. Week before that, our new trades made us $2,463. But again, point being is that the new trades that we're making every single day and calling out are really some of the most profitable positions that we make. It's always great to have some things going into the week so you're always kind of making money off the options that you sell. But, point being with taking a look at that is the fact that we make a lot of our money on a day-to-day basis in the market by taking advantage of opportunities that we see. And follow-up question that I might want to address with that is, where are we posting all these trades? And the answer is a quick plug for our Discord server, which I'm going to pull in right here. We post every single trade as we get in, as we get out, right? We had RDW this week, which was $250 of profit. That was a good one. All of our Palantir rolls are in there. We've got a premium chat room that's a lot more active than the free one that we currently have set up, where we have links to, our watch lists. We have links to option scanners that we use and some of the settings we use to get those. We also have a nice challenge room, which is being led by Jules, who's been, if you click on this screenshot, she's been killing it with some of the call outs that she's had in there. But again, a lot of really good info. It's always going to be free to tune into the streams that we have every week. It's always going to be free to join just our general chat room where we have beginner questions, just main general discussion. We give away 1 free trade a week. This week's trade made $200. But if you do want that extra level of, the premium chat, getting our trade alerts, you're going to sign up for HT Premium, and you could do that by going to hourglass-trader.com. Right on the homepage, you're going to have that Join HT Premium button. It's either $25 a month or $225 a year. That's a discount off of 25 times 12. So if you're in it for the long haul and you're really committed to taking your investing to the next level, definitely worth the value. I know we've had several people who are in our chat room, 100,000 profit group, a couple people in the $250,000 profit group, and that's just from the option selling strategies that we use, talk about and call out in here. So definitely some good value. I'm going to make that the end of my little self-promotion spiel. But if you want to get that value day to day when we're in the Discord, calling out those trade alerts so you know exactly what we're getting in, exactly what we're getting out of when it happens, that's the way to do it. Hourglass-trader.com. So with all that said, we've recapped what happened last week. We've talked a little bit about what we're carrying over into the following week. Let's talk about where we might potentially be looking for trades in the upcoming week. And the best place I think we like to start is with our option scanner. We go to the scan tab of Thinkorswim, go to Option Hacker, click over here, load scan query. And again, these are scan queries that you could load into your own Thinkorswim module via the links that we have available on our website. But we're going to start with high risk on return puts without earnings, right? Because earnings create a lot of volatility. We like to think about those in a separate category because they'll kind of mess up your your scan results, because it's a little bit annoying if you're just running a pure premium scan. You do research on something for 5 minutes, then you find out the premium's only there because of earnings. But here we go. We're going to scan right now. And this is what we've got for the upcoming week, right? 11/26 expiry. There is some super, super big premiums right here. This one looks interesting. CEI. I don't know why the premiums are that big. I know it ran up a bunch on Friday. Oh, there's your answer. It's because it kept running up after hours. So this thing thinks that this is out of the money because technically it finished up at 151. However, it really isn't, and those prices are going to be updated. So that's a false result right there. BKKT is a former SPAC that they merged. They've run far up and away beyond that $10 price floor. So that's one we'd like to stay away from. SAVA had an Alzheimer's drug that got, I think approved, and then they're under investigation for some of those findings. So again, a lot of these results on our option scan are great places to start with trade ideas. However, they're not the end all be all. Just because something is on here doesn't mean it's going to be a great investment idea. So keep going down the list. Rivian, they IPO'd at I think around 90 or $100 at the during last week, and that's just way, way, way overbought for me. So if you look at Rivian, already had a pretty insane valuation off the bat, and it just kept going up from there, peaking at 180 all the way back down. And I mean, there's definitely some premium on these options, right? Don't get me wrong. Even 1% a week is a really solid amount. However, what's the golden rule for us? Never sell an option at a strike that you wouldn't want to own it at. And if we were selling something like a 95 strike put targeting that 1.04% return, which is a great number on a week-to-week basis, I still wouldn't want to own this thing at $94. Now it could level out here, and then that premium would dry up pretty quickly, but it's just not a risk that I really want to take. And decent margin privilege right there, right? It only takes a third of the total max loss to open that trade as far as collateral is concerned, but really not for me. I'm not a fan of the EV valuations, and I'm not going to get greedy, try to chase a 1% return in a week and get kind of crushed for it. And I think that's definitely a potential outcome with Rivian. GoEV, that's another electric vehicle one. However, this is, one that I know off the top of my head was a former SPAC. But again, we're at that 10 strike now, whereas with BKKT was 19. That's a little too high for me. That 10 strike on the GoEV might be worth taking a look at. So there we go, right? And if we look over the last 20 days, it's obviously that premium's there because it's had a pretty big run up, right, from about $8 a share to 13 at the peak pre-market last Wednesday. Let's see if there was any news. Looks like they had earnings between the 15th and the 16th, but the run up really wasn't until the end of the day on the 16th. Let's see. Not seeing any company specific. There we go. They trading higher after the company said it will accelerate its advanced manufacturing production in the U.S. to begin before Q4. So I guess some positive news there. However, let's look at the option chain, keeping in mind the fact that, right, we really wouldn't want to own this thing too far above 8 a share. And over the last 20 days, it went down to 7. So there's definitely some downside there if we get the last 180. It bottomed out at 650-ish right here. We've got one bottom at September 22nd, another at October 11th. That $8 floor is really more of a short-term floor. I think 7.5 looks good because you've got that resistance right over in this area at 7.5. So that's kind of what we're looking at. And then again, there's that secondary floor of about 8 that looks a little bit better on the 20-day chart. So, I mean, if we look around 8 and, you see that there's a 0.95% return here, that would be a pretty big drop in 1 week for this thing to get down to 8. That'd be a 20% drop, but, I wouldn't put it past this stock. I will say one thing that is a little bit advantageous for this setup right here is you'll see that the implied move based on the option volatility is $1.32. However, the market maker move, which is what Thinkorswim says is this proprietary formula that the market makers use to try to estimate the move in a stock over a week, is only at 83 cents. So there's definitely a little bit of advantage for option sellers because this implies that, the actual move of this thing is going to be a little under half of, a little over half of what's implied via option prices. So I think, I would say the 8.5, if you could get 10 cents on this, would be pretty nice because that's a 1.19% return. However, again, 8.5 is a level where if you sold an 8.5 strike put for 10 cents a premium, that's an 840 basis in the shares if assigned. That's still a little bit above where I would like to be at. I think this might be a good one to keep an eye on for the coming week to see if there's a big drop off, like this big red candle that there was on Thursday morning. Opportunities like these big sell-offs after open are really the ideal entry points as opposed to just waiting after a day when it's been pretty flat. And if you look over just this last 20-day period, right, there was one big red candle. We have 3 instances just over the last 10 days or so where there were big red candles that opened. So it might be a good one to throw on the watch list, keep an eye on, and then if there's a big red candle after open, that should juice up some of these premiums a bit, and that would provide us a little bit better of an entry. So, nothing I would be itching to enter into Monday morning at 9:30 when the market opens, but definitely one that would be solid to keep an eye on. And kind of in the same area as BKKT, right? We've got HUT. We have, I saw it a second ago. Where did it go? Riot right here, Mara. These are all crypto mining stocks. And that's an area with how overbought I think Bitcoin is right now that I want to stay away from. And again, that's not to say that, you can't come to a different conclusion than me and say, hey, I'm bullish on Bitcoin. I want to take advantage of this premium, because that would be a great way to do so, right? These things are offering 5.92% return on risk on a weekly basis. But, that's not for me. I'm staying away from that area. And another area I'm staying away from, as we mentioned with that Rivian discussion, is electric vehicles. So LCID is kind of a no-go for me. Moving further down the list. And again, we're shooting down a lot of these ideas, but again, these are really super, super inflated as far as ROR is concerned, right? We like to target pretty much just anywhere above 1%. So there's still so much that's going on down below here that we could take advantage of, right? And if you do keep going, you'll start to see some more familiar, a little bit more stable names. And I think this is the area that I'm going to try to target this week. Zillow is one that is really, really oversold at this point. If we pull up the Zillow chart, this is what you're going to see, right? And we love talking about RSI, and we can go to RSI on a 180-day basis here, and it is in the absolute gutter as far as an RSI reading is concerned. I mean, 15 is about as low as we've seen one in a while, which would, the last time it got even anywhere near this low at about 18 or 19 here, there was at least a little bit of a short-term spike for recovery, and that short-term spike when we're selling weekly options, that's all we need, right? We don't need this thing to be an absolute monster and run back up to 100. We just need it not to continue to drop too far. So if we take a look at the option chain there for the upcoming week, I really like what I see at 55-ish. I know it's not the biggest cushion considering the fact that this thing has dropped over the last 10 days, right? It's dropped from 68 all the way down to 56. But at some point, you got to think, something's got to give. If we go to the 3-year chart, this secondary line down here, if we extend this out to the left, you'll see is where a lot of these candles during June and July of 2020 found a little bit of support before making the run up to 208. So using our technical analysis, taking a look at these charts, I think this is kind of a safer range here in this 50 to 55 range. So that technical analysis gives me a little bit of confidence with potentially selling these 55 strike puts for the upcoming week. And again, even if you're assigned on those, that would just stick you with the 54 basis, which you could roll into the following week, sell some covered calls, knock it down to a 52 or 53 basis, and just keep the wheel going. I think anywhere in the 50s is a price on Zillow I'd be perfectly happy to own it at. And even RSI on a 3-year chart, which we almost never see get down into the blue, is now down into the blue right here, just barely in the bottom corner of this chart. But again, over the last 3 years on this thing, even off some of the big drops that it's had, it's never gotten that low. So RSI, we're definitely banking on that popping back up. And Zillow is one that I definitely want to have an eye on for the upcoming week. So we're going to make our nice little watch list right here. We're throwing Zillow on it. If we go to the next one that I know in the back of my head that I want to take a look at is Draftkings, right? Another stock that's getting really, really overbought. If we go to the last 180 days on that chart, we're going to see it again. It's sitting right in the blue. And this is where we like to attack, right? It's so easy to get caught up in a stock if you're looking at, just this chart in a vacuum saying, okay, Draftkings is killing it. It's up at 64. Should I start selling 64 strike puts? And the answer, typically with how we approach things, is no, right? Because we like looking at RSI. You can see the RSI was elevated for this period. And why do we like RSI so much? It's that if we zoom back out to that full chart, it pretty much dropped off the face of the earth after that. And again, we could look back historically to back in September when RSI was in the blue. It did continue its skid a little bit, but there was enough chop in here during October where you could have managed that basis pretty easily and been able to get back to break even. and I'd imagine even more so down in this 36 level. But when you've got a 180-day chart like this, you know, with the Zillow, we looked back to the left to say, hey, you know, this is an area we identified as support. On the 180-day chart right here for DraftKings, you know, they're kind of in no man's land, right? You haven't seen anything in the mid-30s in the last 180 days. Even in the last year, right? This is the lowest that the stock has ever been at. So let's go back to that 3-year chart. And, you know, we could take a look at these two candles right here. I think these are a good area to look at. And if we extend that out to the right, or excuse me, I guess extend it to the left, you'll see that this line that we just drew comes in at 35.3. So 35 conceivably looks to be some sort of decent support. It looks like you might have another secondary level of support right around here. And this line's been drawn at 30. So I think anything in the 35 to 30 range, similarly to Zillow with how we liked that 55 to 50 range, I think this is a good range to start selling these options at. And again, looking at it from an ROR perspective, even at 34, right, you can get 1.07. Even at 35, you can get 1.8. And that's just ROR, right? That's if you fully cash secure that amount that you're putting in there. If you sold 35 and you want to sell 10 of these, normally that would take $34,000 of collateral if you're selling them fully cash secure. But now it only takes 6,000, right? And because of that margin, or how relaxed that margin is, a $600 return on $6,000 of collateral is now a 10% return on your actual capital, which is a very, very nice value proposition. And again, even if you were assigned, that would stick you with a 34.40 cost basis, which is right in this little range that we said we'd be happy to own the stock at. I really can't see it continuing to slide too much further like this. Gambling is really one of those things that's only going to get more and more legal as we go through. And I mean, looking at this range, I'm perfectly happy to own it in this area. So that is what I'm looking at right there. So with DraftKings, I'm going to throw that one on the list, DKNG. And now this might be a good time to pivot over to a discussion of the overall market, because, you know, these are some more stable, and I know I say stable relatively because this is a pretty up and down chart, but stable compared to some of the more higher IV stocks that we trade. But I'm really hesitant to get in more stable stocks until we see a bigger pullback in the market, right? I mean, this is just over the last 3 years. We have a video on our YouTube channel where, you know, we see this 1, 2, 3, 4, and 5 over here. That's slightly off the chart, but where we do look back at drops in the S&P 500 and what those similar drops would look like compared to where it was trading at recently. And that's what these red lines here represent. So I think there's definitely a lot of potential downside in the coming months or even coming year in the S&P 500. That scares me a little bit, but being cognizant of that potential downside is always something that we want to be aware of, right? Because if we protect ourselves on the downside, we are going to be okay. So that is what we're going to be looking at. And I'll enter into some of these like Zillow and DraftKings, because if the market keeps going up, look, I'm not going to be sitting here and foregoing any profits like that. But always be sure that you're selling a little bit out of the money, so if the market does start pulling back, you at least have a little bit of protection. So similarly to DraftKings, Penn is another stock in that area that has a similar decline. However, with this one, you know, it's really, really in no man's land. This last level of support that we identified at 53.35, because it bounced off there back in 2020, back in November and in August. But it's broken through that. That candle is through the bottom of it, and the next level of support really is around that 40 level that we could see right here. So as far as Penn, you know, while these names do kind of move hand in hand with Penn and DraftKings, this one's a little bit scarier for me. However, with that extra risk comes a little bit more of a return, right? You can go a few dollars out of the money here and still get that 1-ish% that we like to look for. However, potential downside I see on the chart here is to 40, whereas potential downside on the DraftKings chart that we're seeing is really only to 30 and 35 in the short term. So I'm much happier to sell at that 35 level or 34 level, still get that similar return. We know earnings are behind us, so there aren't going to be really any big binary events that could throw a wrench into things, but that is what I like to look at, and that's what I'm going to be having my eye on for the upcoming week. So DraftKings and Zillow are a couple good ones that I think would be nice to get in on and initiate positions. Let's see if we could find a couple more as we head in, or I guess as we approach an hour on the stream. And I know, Jules, you had a stock that we wanted to look at, so let me see. DGLY. Let's take a look. There you go. Digital Ally trading at $1.43. Take a look at that chart. We see that there's a base around 64 cents. It looks like potentially a secondary floor around $1.10, but crazy volatility. But a lot of time that crazy volatility breeds some really nice option premium. So Jules is talking about the one strike puts for January, which are going for about 10 cents a piece. And again, really nice number right there. It is 61 days till expiry, so that's a decent amount of time, right? How many weeks until January 21st? We've got 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks. So over 9 weeks, 10%, 11% return is really just above 1% a week, which is what we like to aim for. So I guess if you could get 10 cents, not the worst thing in the world, it would stick you with the 90-cent basis down here, which is right around where it was previously trading. Definitely a little bit riskier to hold one that moves this quickly for this long, but I think the numbers kind of check out, right? The 63-cent market maker move that we have right here is a lot more in line with what they have here with the 72-cent implied move from that option premium, and that would stick you at about 80 cents, which you'd be looking at a loss. But if you were going to keep running through with the wheel, February has some nice option strikes as well, spaced out in 50-cent intervals, where you could potentially have some decent flexibility to benefit from there. But as far as for me, something this volatile with how these things typically decay and the low volume, right? Even if this thing did drop from 10 cents to 5 cents this next week, it would probably be tough for you to get out of that trade for a 10-cent debit with the lack of volume that there is as of right now. So, that's kind of what we're looking at with this. That's how we make our evaluation. I'm not the biggest fan of this. Maybe one that I would like to hold off on for another couple of weeks and maybe reevaluate to see if you could still get that 10 cents right there. But that is my 2 cents on DGLY. So let's keep looking here. Let's keep looking. None of these names are really popping off the page to me as far as things that I could sell. Stitch Fix, maybe, because I think that one's pretty beat up lately. SFIX, yeah, there you go. And are we approaching any support levels? It looks like there might be support right around here. And that line is what? That's been drawn at $22. And the top end of this range right here is right around $30. So it's below that top end of the range. 22 looks like the next support level. They had earnings recently. They don't have them probably until December if I had to guess next. So you've got a little bit of time there. But 27, this is a little bit too close to the current price for me with how that chart is looking. Even just on Friday, this thing dropped 5.36%. So, moves like that I think aren't out of the question, right? This thing has dropped a full $8 in the last 15 or so days. So not really one that I'd be too keen to jump in on. We could take a look back at the scan. Not seeing anything too interesting here. There's Zillow again popping up. Let's go a little bit further down to the 1.5% return range. Again, these are things that come across and come through our chat a lot, so we're familiar with how a lot of these work. So I'm not just completely blowing these things off. I know things like Affirm at 128 is way higher than I would be interested in owning that at. And let's see, CRISPR, there's our guy CRISPR right there offering some decent returns. That's a good one to jump in on if you haven't yet. And I guess talking a little bit more about what we jumped in for the upcoming week, I know we had a longer-term UWMC trade. However, they introduced weekly options on it this week, and there's some really, really good opportunity in these, right? So this thing was trading at around 540. It jumped up to 817 at one point pre-market on Friday morning when they announced some news. However, I think it's good to evaluate what caused the drop and then what caused the spike, right? Because it was trading pretty steadily around this $7 a share range. And then they had earnings. Earnings were okay, right? Because this is when they had earnings. There was a little bit of a rise, then a drop, and just an overall flat earnings. However, the big drop here occurred when they announced that they were going to have a share buyback back on November 17th. So if we go to the news feed, we go back to the 17th. There you go. They pretty much said that they intended to offer for sale in an underwritten secondary offering 50 million shares of stock, which is pretty significant. And that's why we saw a drop all the way down to 541 at the lowest for UWMC. However, what was the news on Friday morning that jumped it back up? So they said they want to accelerate their buyback in public market in lieu of previously announced secondary offering. So their initial idea was to, sell a bunch of shares, then rebuy them on the market, which I guess, would have made sense because they were about to scoop up a bunch of these for 550, a little bit shady. However, instead of having this offering at all, which is what made it drop, they're now doing just a stock repurchase, which is bullish for a stock. So from here, the news that brought it down from 7 is no longer in play. And now you have this additional piece of news that they're going to have a stock buyback, which I think should bode well for the stock moving forward here. I mean, we saw this thing spike to 817 on a Friday morning. So I think there's definitely some upside here. But to take advantage of that, they have these weekly options now. 6.5 strike is fantastic from an ROR perspective, right? 6.12% ROR. But even if you do want to be a little bit safer down at the 6 strike, you can go between 10 or 15 cents to get 2.13% return on capital risk in just a week. So I think that's another really good trade opportunity. And we talk about margin buying power privileges, right? This thing would take $6,000 to sell 10 of these fully cash secured. They only require about less than half that. So really a 350 return on $2,500 of collateral is over 10% return on capital in a week, which is a fantastic number right here. And again, if we want to use that concept of the MMM, the market maker move, they've got that at 46 cents, which would peg the low end of the range for the upcoming week at this at about $6 a share. So I think these are very, very safe and might require even less collateral, right? There you go. $100 on $2,100 of collateral is about a 5% return on capital in a week, and that's a fantastic number. So that is what we added for the upcoming week. And I think, unfortunately, there aren't a ton of earnings coming up with whatchamacallit, with Thanksgiving this week. I don't think there's really anything Thursday or Friday. I think we might have, don't remember if we actually put the picture into the Discord server. We did not yet, so I'll have to revisit that at some point. But we can go back to the scanner, take a quick look at some of those names that are reporting with earnings. Scan for that. And there you go. Things like BBIG, that's already a pretty volatile stock. Zoom is reporting earnings, but again, that's one of those stocks that I can't help but feel is just like the peak of their potential revenue happened during COVID. One of those companies where that's kind of a best case scenario. So they're probably going to be on the way out, not something I'd want to be invested in long term, so I'm not going to be selling puts on it. None of these other stocks are really jumping off. Again, I think earnings are pretty light this week. We've got DocuSign, which I think DocuSign might be a little bit overbought right now. Not too bad on the 20-day. On the 180-day, definitely a little bit elevated as compared to that 180 low that it had back in May. But again, this is one where, they've got earnings coming up, so there's going to be some pretty big premiums on the puts. And it looks like the earnings may not be this week. They may be next week. It looks like they're going to be in that week of December because these premiums are a lot higher. Because I think I've got this scan set to pull up earnings in the next 10 days, I think. Yeah, 10 days. So I think that would suggest that they're at the front end of next week. But, might be a decent one to keep an eye on because you could sell pretty far out of the money here if we look at the December 3rd strikes. There you have it. You can get 1% down at like 235, which is all the way down here. And that's a pretty dang big cushion. And we could also do something that we like to call the 10-day trade, which is something we like to do not for earnings week, which is going to be that December 3rd expiry, but for the week right before. And what we do is you sell an option that's pretty close to the money, right? Because historically, companies go up greater than 50% of the time the week before earnings. So you have that statistic on your side, right? So if you sell a put that's near the money and the stock goes up, you're going to make money on that. And then you're out of the trade. You don't even have to worry about it again. But again, if it goes down, you now have these shares, which if we did like 260, we would have shares at a 257 basis. And then for earnings week, the call premiums are super, super elevated. So we'd have a 257 basis. We could sell one of these for double digits. That would get us down to a 247 basis. And then heading into earnings, our break-even price would be at, if we go to the 20-day chart, we'd have a break-even price right around here before even having earnings be announced. And then if, it drops below that line, we could roll those calls down and drop our break-even even further. But, the idea with that 10-day trade is that you have an option 1 right here to pick up premium if the stock is just flat or green that week. You have option 2 here to pick up a profit if it goes up after earnings. Or you have option 3, which is to pick up profit if it drops, but you're able to roll those calls down and then it rebounds. So really 3 opportunities in 10 days to have a profit on a trade. So we call that the 10-day trade. And DocuSign, this might be a fun one to just kind of roll with, sell a 260 strike put. Obviously, that would be a decent amount, $26,000 fully cash secured, but with margin privileges, it's only $4,900, and a $315 return on that is just under 10% return for a week. So I like the numbers right there. DocuSign for a 10-day trade might be an interesting one, so we could throw that on the list as well. But outside of that, don't want to spread myself too thin, right? Because we still have a decent amount of money tied up in Palantir right now. I really want to see this CRISPR play make it to the finish line, because that also has about 25K allocated to it. And again, if you're joining us, don't get scared by the big numbers, right? This strategy can apply to accounts of all sizes. Just don't sell 10, don't sell 3, don't sell 100 of these. And, you could scale into these positions as is appropriate for your account. What's important is the fact that you could replicate our percent returns. And while we were at a negative percent return last week, the idea is that, this year we're still over 100% return. So that is what you can replicate regardless of account size. So that's what we've got lined up for this week. We might enter into a few of these come Monday morning, but again, I think a lot of the value is going to be coming from the Discord server, what we're doing in there, and making those trades on a day-to-day basis, identifying good implied volatility reversion opportunities. If a stock has a huge drop after earnings that's way oversold, jumping in on some of that excess premium. That's been a strategy that's been pretty good for us so far, but just keeping an eye on things, alerting things in our Discord server, and that is going to be our game plan for the upcoming week. And Jules, with one final request, if we have extra time, we can check out SI for Silvergate. Not our favorite chart, but we'll see what we have to say about the 185 strike put. So there you go. Already up 10% just on Friday alone, so I know Jules knows that I hate the entry on this. But, even just the 20-day, the low is 146. We go to the 180-day chart. Looks like way too long of a way down here for me personally, right? RSI is getting a little bit elevated, and for something as volatile as this one, it could get much higher. But I do think I remember off the top of my head that this is a crypto-related stock, and we could maybe confirm that by going to the fundamentals chart, typing in SI under the Analyze tab. Let's see, digital currency. Yeah, so there you go. It's kind of a crypto-related stock. And just in general, I think that whole area is running just a little bit too hot, right? If we back up to like the 3-year, for the last time we saw the big crypto jump, it leveled out. I would say wait for these to come back to you, let them level out. And again, I guess if you wanted to sell a 185 strike put right around here, let's see what that would be offering for you. $10 a premium, that's not bad. You're still 4 weeks away from that. This would kind of fit the 1-ish% return a week level that we like to look for. Market maker move here is 26, which would imply that 194 is the bottom end of the range. So, selling a 185 put checks out in that regard. However, 185 is here on the chart. That's kind of at the top of the wicks of these candles. I think maybe getting down to this level where the thick part of the candle gets up to at about 165 might be a little bit better of a value proposition. Let's see how far down you can get some premium on these things. 165 is still 3%. I don't think that's a bad idea either. I think one of these where, especially if you're selling one that's 26 days till expiry, one of the interesting things about the ways that options decay is we know that the theta decay chart is exponential. However, the actual rate of decay is dependent upon how far out of the money you are. And about 30 days till expiry, if you're pretty far out of the money, that 30 to 45 day window, some of the theta decay is actually a little bit sharper. So if you're in this range where you're 26 days out, going a little bit further out of the money can help yourself out a little bit, and then you might be able to close these even early for a nice gain. So that would be something I would be interested in looking at if that's a stock that you like. Not for me because of the space that it's in, but I think the way those numbers line up, taking into account how theta decay works for something that's 26 days away from expiry, that's going to be the way to do that one. But with that said, short list, Zillow, Draftkings, DocuSign, those are all going to be names that we have an eye on. There we go. I was just thinking to myself that I could potentially get through this without talking over and stumbling over my words, but that apparently is not the case. But this is what we've got for the upcoming week. Again, when we mess around with these numbers, if UWMC holds above 650, even if Rocket Lab has a little bit of that premium fall off of it, Palantir reclaims just 22, not asking a ton on that one, and then CRISPR finishes, profitable. That's already $3,500 of profit right there, not to mention the potential max profits we could add from these types of trades. So I love the way that we're set up for this week, even though we have a pretty short list. But with this short list comes a decent bit of buying power, right? We've only using about 33-ish% of our buying power right now. So I'm really happy with the flexibility that that's going to afford us and hopefully allow us to enter into some decent trades on a day-to-day basis. And I do have a theory. I mentioned that at the end of my streams, I've got the corny little sign off that we use. And I mentioned that, every week that we didn't use it, we lost money. The last time was back on 9/26. However, we lost money this past week. But at the end of last week's stream, I was told that I pressed the stop streaming button a little too soon because there's typically a 15-20 second delay between what I'm saying and when you guys hear it. So I'm going to say it. I'm going to wait about 20 seconds to make sure you guys hear it. And I think that should give us, the good luck that we need. Because, in addition to all this analysis and chart watching and, studying that we do, a little bit of luck never hurts. So for those of you who have tuned in on this Sunday morning edition, and for those of you who are watching the replay at some point, if you've made it to the end, thank you for watching. This has been the Hourglass Trader, where as time passes, we make money, and hopefully we'll be talking to you again next week with more money than we currently have right now. So I'm going to wait 30 seconds, and then I'm going to sign off. But thank you guys so much for watching, sticking with me, and supporting us through all this. Appreciate it.